Hello and welcome to the show. I'm Puneet Wadhwa and we have with us R Bhat, co-founder and director, Alphaniti Fintech with us on the show today. Hello, Mr. Bhat, and welcome.
Good morning. Thank you.
The markets have seen a good run in the last few weeks with the Sensex now above 65,000 levels. How sustainable is this rally? Would you call it irrational exuberance? Are they entering or are they already in a bubble territory now?
Well, I think if you see from March, FIIs have pumped in something like about $8 billion. And quite surprisingly, even the DIIs, the domestic institutional investors, also have been buying at about $4 billion. So this is somewhat rare. So combination of FII and DII flows have taken it, say from March, the Nifty is up by almost about 2,300 points. So this is unprecedented, and we have seen historic highs. Well, I think as long as the flows continue at this pace, there probably could be some momentum. But otherwise, on a valuation consideration, I think we have reached territory where it's very uncomfortable for fundamental investors to invest.
Should we expect a correction in the immediate term?
Well, I think it is possible because everything, all the good news has been factored into the market considerations now. But there can always be several slips between the cup and the lip. And I think any negative news, I don't think there is any scope for any negative news to be digested by this market at these levels. So if there is any negative news, I think the market will probably correct probably a bit steeply over the next 3 months.
So if you were to name the three risks that our markets are ignoring right now, domestic as well as global.
Yeah, domestic, it would be largely, things like, the federal election is likely to be held in the next few months. So, in fact, if you see historically, the year before the federal elections have not been very good for markets. So that is one phase we are going through now. Plus, of course, all said and done, our exports are not really picked up very well. So that is another area of concern for us. Other than that, of course, valuation is a very big risk because valuations are in territory where I think most fundamental investors are not comfortable. So, I mean, these are the three domestic risks. Plus, of course, you have in the run-up to the election, you have some of these legislations that are being introduced, some disturbances in the Northeast. All these issues, we have to see how these things get tackled. But these are all very important precursors to markets doing very well. Plus, of course, in the international scene, you still have not seen the last of the Ukraine war. I think it is probably escalating even further with all these problems that we saw recently in Russia. So I think even the West probably seems to think that Russia is not in the same position as it used to be. So they might sort of up the ante, and so this can affect sentiment globally. Plus, of course, you always have these continuing problems with between US and China and the South China Sea. So these are all things that are flashpoints, potential flashpoints, which I think will determine the state of the market as we go along.
Are there any investable stocks and sectors at the current levels, or should one just take the money off the table and hunt for a relative safer bet?
I think for retail investors that could be a good bet, but I think those who are in sort of systematic investment plan schemes, I think they should continue because I mean that is something that will get averaged out over time. But for other investors, large investors, I think they should probably ease down on further investing. And because there is quite some valuation excess, if you see in quite a few sectors, especially the export-led sectors. Even for auto, for that matter, I think things have not been very good over the last few months. But the only probably pocket of some relative valuation could be the public sector banks, which have come out with very good results and are on a different sort of glide path now. So there could be some valuation comfort there, but otherwise most of the sectors I think are a bit stretched in terms of valuation.
From a long-term perspective, do you think that the markets are still relatively safe?
No, I don't think so. At these levels, markets cannot be termed to be very safe. There's a fear of missing out, so people want, because it's going to new highs every other day. So therefore, people don't want to miss out. So therefore, people are there. But most of the smart investors, if you really see, they are always looking over their shoulders and seeing whether someone is getting out. So I think one has to be very careful at these levels. One has to sort of probably the big investors need to hedge at these levels, but at the same time not miss out on potential upside. But I think for the smaller investors, I think it's much better to sort of stay put for some time, not invest further, and probably pare down some holdings for some time. As the outlook, as I said, in the run-up to the election in India, it cannot be anybody's argument that markets will do very well.
So what is the kind of fall that one can see? Would you like to give it a number?
Well, I think at the best, based on the on technicals and stuff like that, I think in this particular run up, I think the best that the market can go is probably 19,550, 19,600 levels in NSE, but NSE Nifty. But that is sort of a bit far fetched, subject to everything else being fine and the flows continuing very strongly. But I think the base case is for markets to probably stabilize to correct from these levels.
One last question. Your views on the mid and small cap segments. They have actually outrun their large cap peers. Do you find a cause for concern as regards these two as well?
Well, I think on a broad brush basis, I don't think there's great value left there because they run up very well. But I think there are specific cases where there are new discoveries, in the sense, I mean, new stocks that have come to the market, new stocks that have got dramatic growth potential on account of changed outlook in the market, or new sectors that have been created. I think such stocks, specific stocks, there might be good earnings potential and value. But across the board, if you see broad brush, I think across the board, the valuation is excessive. And that goes true with even the mid and small cap stocks.
Are the investors now warming up to the primary markets given the recent issues?
Well, primary markets are, if they are appropriately priced, I think there are always demand. But it's only when during the peak of the bull market, valuations become excessive, and issuers expect much better valuation than what the markets can afford. That is when there is a spectacular failure, and then things take a turn for the worse. But right now, the ones that are coming to the market are the ones that are coming with good earnings and good prospects, new sectors. So I think that is why there is a lot of interest. But I think it only takes one mispriced large issue for the primary market to start correcting.
Thank you so much for your time, Mr. Bhat. Today, we hope to see you soon.
My pleasure. Thank you very much.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's about to land his dream job. Business Standard.